Hey, what's good, everyone? Welcome to this TrendForce training. In this session, Dad is going to take us through exactly what it takes to move from becoming a retail trader to a professional trader. Trading like institutions, it takes a huge leap mentally, not just our pro indicator. It does require a shift in the way that we think. You know, it's not just about chasing signals. It is about learning the way that the market moves because of the market movers. And so institutions are the ones moving these candles, and we have got to go on the journey of learning how these guys trade. And so in this session, Dad's going to give you a whole lot of value. Enjoy it, take some notes, and we'll see you on the inside. Welcome, everyone. Tuesday night training, and obviously we have all got TrendForce Pro now and getting the swing of it. And so if you didn't notice earlier in the chat today, right out the gate, this playlist should be saved in all of your whatever YouTube lands you follow, because right at the bottom there, you can see the latest two. Key level setup, volume anchor setup. Those two videos Dad and I made specifically walking through those key components. So go watch those if you haven't. The volume one, I guarantee you're probably going to want to watch it more than once, because we go through everything that you need to do to set up your left hand and right hand chart. We split our screen in half and we went through it in a lot of detail in there for you. So enjoy that. But tonight, Dad's got a bunch ready for us. We're diving into all sorts. I'm not even going to try to get into explaining what he's going to get into, but a lot of the mindset around what it is to become a pro trader with TrendForce Pro. And so there is a mindset shift. There is a philosophy in a shift in going from being a retail trader to trading like institutions. It's not all about signals, guys. That's the biggest shift that we've got to emphasize. It's not all about signals. It's learning how to read price, rejecting levels that institutions are battling over. So enough from me. Good to have so many on here live. I don't know, a bunch of you are going to watch this later. But for now, Dad, I'm going to find you and let's rip into it. So I got to find you. There you are. Gotcha. And pin.
Here I am.
There you are. Thank you. Thank you so much,
Yep,
as always,
cool.
for prepping a ton for us, for working loads behind the scenes, recording extra content for everyone. Really appreciate you, and I know everyone else does. So I'm going to get my stuff out the way, and over to you.
Cool. Well, I'm going to jump straight into share my screen with a couple of things I want to show you. Am I all legal to share? There we go. Well, anyway, good morning and welcome. Good evening. Good morning to the Netherlands. Good evening to New Zealand, and those in between, and maybe good afternoon, maybe any time. So we're going to jump straight in. Lots to say as usual, but I enjoy preparing these things because it's all the studying I do. So I love to study trading and how things work. And so the notes I make are things I'm sort of studying myself and learning and growing. So everyone benefits. So there is an update. So Ty, I think you've already uploaded it. You may have seen, I don't know if you got a notification, but there was a slight bug in that if you try to trade currency pairs, then the indicator timed out. So I fixed that. And so there's only one slight catch. So if we just look at the settings, you'll see I've edited a slight note here. So if we go to the prior month POC on info, it goes on the M3 chart, but it says will not plot on currency pairs. So that's just a limit with TradingView. And with the computer code language, it just can't do that. So it's kind of outrange. Occasionally, you may get like the POC, VHL, one of them or two of them overlapping, but you won't get that on currency pairs. It'll have everything else. It'll have the prior month, highs, lows, and mids, prior weeks, etc. Just the prior month POC you won't get on currency pairs, but it doesn't always show, so you're not really going to lose out. Price is just exploded now. Here we go. This is the London Open. It's at now early. Look at that. Price has bolted up. Let's just see from that signal there. Price has gone up, more than 80 pips there. Wow, big move. Anyway, so that's the one thing. The other thing, people have asked me and we did do the video, but what should my charts look like very quickly? I know one of the trickiest things is to set up the anchors. So I'll just quickly show you what they should look like. We'll only take a minute. We got time. So we're now on the Dow. So we changed it to the 4 hour. Let's just go to the 4 hour where you should have your anchor. That hasn't changed. So if we're looking now, your 4 hour anchor, which is on the 1 minute chart, the left-hand screen, should be anchored from the 11th of February. And so we're still in that move. And again, you can see how price loves to respect. Look, price came rejected, went to oversold, moved up to the mid VB, rejected that, continually moving between the bands. So that's what your 4 hour chart should look like. The 4 hour anchor, so I'll delete that. Let's just go down to the NAS and see what's happening there. So where's the last big move? And again, it's not an exact science. So this is the NAS on the 4-hour chart. I would probably have the anchor over there because we're still kind of in the range of that move. So, it can move around. So again, if you're on the NAS, we go to the high, and that's where your 4-hour anchor should look. And then you change it back to 1 minute. So that's still very much in that move. We can see all the major bands. Look at the low VB here, price respecting, rejecting. And when they pop up on a 1 minute chart, they're massive. I mean, look at this big move here from going down to the oversold line. Then if we go to gold, so we'll delete that quickly and go to gold. Let's just look at the gold chart. Where should your 4-hour anchor be? Still in the same place. I haven't moved that. So that would be down in this low. So if we just click on our anchor, put it on that low, and you can see those bands play out. So those are what your 3 anchors should look like on the 1 minute. All right, so basically you change it back to the 1 minute, and then you'd see how those bands will come into play. So reset the chart view, and I'm just going to go back to the Dow. Then the 3 minute, we'll just look at one chart quickly, because it is in the video. We'll turn on the indicator again. And before I start doing some more training, so on the 3 minute chart, if you were, this is the confusing part. It can be a little confusing. I've already updated this chart, but on the 3 minute chart, we set it to weekly. So we can see here that the bands are now set to weekly. This morning, we've set it to reset mode. Let's just hold it. I'm still on the 1 minute. This is our 3 minute chart here. So the 3 minute, we set the bands to weekly. So if we look on the settings here, we go to custom and to weekly. So I've already changed that today. Now, the only little trick, as you may have heard me say, for the Tuesday, if you trade the Tuesday morning, I change that to manual time and date, and I just go back to the open of the previous week. So if we now go to March, and so at the moment we're on the 10th, I would have set that to over there to the 3rd, to the last week, just so we get the bands lagging. But right now you've got to just set these bands. This is what it should look like now. If you're trading tomorrow morning, we got custom on the 3 minute chart. We're going to set it to weekly. And so if you're trading even now live, or you're going to trade tomorrow morning, New Zealand time, then those bands will be in the right place. So then we also have to set the bands, the other anchor, to monthly. That's pretty simple now. So if we just go to our calendar and we go to the start of March, the first open would be the 3rd. And we can see now we actually still at 3:30 from the last week, that's the beginning of the month. So if we go there now, it should take us, that's where our anchor is. We can see here at the start of March, the 3rd. So that's where our monthly anchor should be, March the 3rd. All right, so I will remind us, if I change my 4-hour anchor, I will take a picture and put it on the screen so we'll all be in the same place. So that's be the same for gold and also for the NASDAQ. You just set it now to the first US open of the month. Then just one other thing.
Hi, Tim.
Yes.
Our market open is on Mondays and not on Tuesdays.
That's right.
So what should we do if we are in Europe? Because
you simply set it to when the US Open is your time, which is like 2:30 or 3:30 in the afternoon.
3:30 Monday afternoon is that?
Is that when the US Open is now?
Yeah, that's when the US Open was, and by time change, it will change maybe 1 hour. It's 1 hour now, changed now. But we set our anchor on that open on Mondays. Apparently.
On Monday, yep. Whenever the US Open was on that Monday.
Okay, thank you.
Okay, then the other thing is I have coded daylight saving to all indicators. So when you press this to weekly, this is just the default for the manual. So you can see here, you should know this by now, you can enter manual date time. I've just set the default to 3:30. But if you press weekly, it's automatically going to set the bands to whatever the open is in America or whatever time zone you're in. So if you're New Zealand, if you click weekly, that will plot at 2:30, which is the open. So it's all with daylight saving. It's only manual. You need to change the time there. All right, so let's maybe jump into some training. I'll leave the charts on, but I may just reference a few things. So Taz already made a good point. So I want to talk about, I think I put it in our feed there, just the difference between retail trading and professional trading. So we've made this big shift from retail to professional. And there is a big difference, and it will take a little bit of time to kind of sink in and to get it, because it is a total mind shift. It's a different way to think and a different way to trade, but very much a better way to trade. So I understand, look, it's only just been over a week. And I mean, this is, as I said, I've said it a few times, I think at the training, we're not just going from, version 2 to version 3 or version 3 to version 4, where we did previous updates. Those were all still in the retail trading space. We've actually changed our whole modus operandi. So it does take quite a mind shift. And so I thought of maybe 8 differences while I was kind of preparing this afternoon. I was thinking, what are 8 differences that could help us just understand making the shift? And I think the first big one, because I can still see the way, questions are being asked, is that one of the biggest shifts compared to retail trading to professional trading is moving from signals to levels. All right. So that's really one of the major shifts, is moving from signals to levels. So retail trading is all about entering on a signal. And so most of them would center around moving average crossovers. I mean, previous strategies we've tried were all about moving average crossovers. We also had the MACD crossover that was part of for confluence or confirmation. And so retail trading is really all about indicator signal. So whether it's, in the main screen or the lower pane where you find your oscillators. And so that is a big shift, because with professional traders, they look for levels. So I think I said it at our live event, I may have said it a few times now, that when you see professionals trading, they don't have buy and sell signals. They just have a lot of lines on their charts. They're looking only at levels. And so they watch price interact with key levels. And of course, they trade the rejection or acceptance, depending if the trade's going to reverse or continue. And that is the heart of what we're shifting to. So yes, we do still have signals, but they're simply for confluence. So that is a key mind shift. So I'll say it again very slowly. So with retail trading, your entry point was a signal. Then you looked for other points, other areas of confluence to support the signal. Is there space, etc.? Those kind of things. But with retail trading, we still have with professional trading, we still have signals, but they are for confluence. Our primary entry is off a rejection of a level. So there are, more than one person has said, gee, there are a lot of lines on the chart. There are. But I want to say, first and foremost, those lines are not there to make you money. They're there to help you not to lose money. All right, because very often with retail traders, they're not aware of the critical levels where value and volume are based. And so very often, you take a signal and suddenly goes the other way. If you're a retail trader, you may have no idea that the monthly POC was, maybe 5 pips above your entry or below your entry if you were going short for a sell. And so that is quite a big mind shift, because before we all looked for signals, we set alerts for signals. You still can. The 3-minute generally is pretty good. If you looked here, there were some good pips in that buy. There were some pips in that sell. They were risky, and there are pips in that buy on the 3-minute chart. But that is the big mind shift, So we are really looking at price rejecting a level as opposed to waiting for a signal. And that's the key thing, is what creates momentum is rejection of a level. And so once price rejects a key level, that's what normally leads to momentum. And so that's why the safe trades, and that's obviously our main entry rule that we try to emphasize, is we're looking at when price rejects tested key levels. So once a level has been tested and price rejects it, then we enter. And so that is the big mindset, is moving from signals to levels. So I hardly ever take trades just on signals. The good ones, I mean, here's an example. Look, it's not a good example. I would have loved to have seen price, reject some key levels here, which if we just look on the 1 minute, let's just see, yep. Okay, that is not the safest trade, but we can see on the 1 minute, price broke below, oversold, came up, retested a key level. And then also we can see here, the big round number, it rejected a big round number. So it did test and reject key levels, but I would like to have seen something here also on the 3 minute to have taken a trade like that. So I forgot what point I was making, but anyway, we enter, we don't wait for signals. So if there was, say, another key level here, our entry would have been way back down over here, not waiting for a signal. And so again, we look at key levels, they are way more superior to signals. And so sometimes, let me just look on the 1 minute chart here. I mean, I just ignore certain signals. I just absolutely ignore. Even if there's like this one, there's a buy signal in the middle of nowhere. Yes, price moved up, but look, below there was no testing and rejection. There may have been something there that we can't see, but I never ever take signals just in the middle of nowhere. Like here's a sell signal in the middle of nowhere. Yes, it moved. There was a reason for this. I may reference it later. But the signals that are good is when they are linked to levels. Like here, look at this price. This is the M15 resistance line, the opening 15-minute high. Look at multiple tests of testing, rejecting, plus it also tested the upper BV. Then we got a signal. Really, if that signal was one candle earlier, that would have been way superior. But that's what we're looking for. We never just take signals that are in between in the middle of nowhere. I'm trying to find another example. I mean, there too, there's a signal in the middle of nowhere. On the 1 minute chart, prices rejected nothing. Those are invalid. I wouldn't touch those signals. This is what I look for, is when you've got a signal and prices rejected key levels. Those are the valid ones. So use them more for confluence than for a key entry. All right, so that is the most important one. I've got 8 points, so that is the key one. And then the next one, it flows on, and that is retail traders. Let me just get this chart to a fresh position in case something comes up. Gee, that was a big move. Hey, look at that. All right, then point number 2 is indicators versus structure. And so retail traders are big on indicators. So that was my journey. I mean, I was researching indicator after indicator, and I always thought when I found a new one that would make it profitable. Then I started, coding myself, and we still came up with something good. But most retail strategies are built around indicators. So you'll find that, moving averages, buy and sell signals, MACDs, RSIs, stochastics, those kinds of things. Those are largely what retail trading is built around. Whereas professional traders, as I said, they build more about structure. And so that's why these levels are market structure. So when you see these bands, like let's put the 3 minute chart on. It's got a few more levels. You can see how there's not much in terms of indicator, although in a sense, the big picture TrendForce is the indicator. We can see the main thing is not lots of trend zones, lots of moving averages. So we can only see 3 moving averages on this chart. Professionals trade around structure. So here we can see a clear structure. We've got levels, we've got bands. You can see how price is respecting and rejecting these key levels. Our upper volume band, we can see here, price came up to, our previous week, valley area low, rejected that. That's what caused that move. And so that is a key thing. So we build around structure, not around indicators. So basically indicators, the weakness with the indicators, everyone knows that, is that they all lag. You can't get around that. Indicators lag. So really, they're describing the past. They're describing, what happened really, not why it really happened. And so, but levels really control the future. So indicators control the past, levels control the future because they tell us where price is likely to go. So here we can see a rejection of the upper BV, the weekly band, and after that price moved up. I mean, there was a big pullback, but look, it moved up to another key level. There was 140 pips in that trade. So it's really key to see that professionals trade around key structure. And so price moves between the levels. That's the key thing. all the time, price is moving between levels. So here we reject a level, we move down to another key level, reject that level, move up to another level, back down to another level, and we can see prices continually moving towards levels. So right now we can see a lot of, looking back here, look at the H1 high plus 2. We're almost out of range here with our H1 levels. So we can see again a lot of rejection. Yeah, price is rejecting. And finally, when it breaks through, that means it's accepted. And when it's accepted a level, there's continuation. Obviously, something in the way here. We did have a pullback, but right now don't press buy now. But right now, there's a high probability that this trade is going to move another 30 pips to the H1 high plus 3. Why? Because we've tested and rejected the H1 high plus 2. That is the next logical target. Just by the way, it does happen that I've only gone to 3 deviations. So our H1 high is way down here. There was that huge move this morning on the Dow, hundreds of pips, and that was technical analysis, by the way, wouldn't have explained this move. So from this candle here, we can see price rocketed up, 600 pips. Yes, it did reject a level, but that was simply fundamental analysis. Trump saying the war's almost over, the war's won, and that brought optimism, to the markets. So sometimes it may, if it ever happens, I want to show you something while I'm still on this point, is that these levels are based on, the mid H1. So these are just deviations of the same number of pips. If you run out of space, it could happen. For example, if price hits H1 plus 3 and there's nothing else in the way for a target, measure the pips to the plus 2. You can see that's, 240 pips. Then H1 plus 4, you could draw a line over there where 240 would be, if you had a parallel line, that would be your next target. So, it's hardly ever happens that price will end up going H1 high plus 4, but fundamental analysis, pushed it all the way up there. So that's a little bit of random trivia, but let's just see if price hits this target. I said that's the next logical target. You see, this is basically how professionals trade, price is constantly moving between levels. And once you understand that, trading becomes way easier. So, there's nothing is guaranteed there. We just hit that target. What did I say 30 pips ago? There was an easy 30 pips. And we've now broken H1 high plus 3. That would have been a very easy pips on the Dow there. Maybe someone took that trade and trusted my knowledge, bright candles, but it would have been a late entry. So that would have been risky. Anyway, so I was saying point number 2 is retail traders trade indicators, whereas professionals trade structure. All right, so they basically know what's good, and they've got a far better idea where price is likely to go. So we can see how we're heading up towards the 2584. So very often price will retest. So we haven't closed above, so that would have been the safe target. Price could totally reject this and come back down to the previous week VAL. So it'd be interesting to see how that trade plays out. But that's why we have so many lines that we need them for targets and to work out probability and where trades are going to go. Anyway, so Ty, can you keep just a track for any questions? Let me just move my notes aside there. Then, okay, this is the next one. Now, I say there's so much to learn. I know for some of us, it's a big shift. I've been doing this for months, testing, coding, back testing, then writing the code. So obviously for me, I'm familiar with what we're doing, but it is a huge shift. So there are many things that we haven't even covered yet. So this is kind of coming in layers, but I believe, the basics, there's enough basics to make us profitable, but obviously to really ace it, we need to learn all these layers. And so that brings me to my next point. And that is that another difference between retail trading like we used to trade and how we're trading now is basically how we look at our risk reward ratio. It's very different. This is looking good for TP3, by the way. So I'm just having a look here. How from this buy signal, we have now moved up how many pips? 200 pips. That was a good signal. So you can see every signal, every single signal here. But look at this. Every single signal from this morning on the 3-minute would have got a lot of pips. Look, there's a win, there's a win, there's a win, there's a win. I'm not saying take them all. That would have been a win. Okay, yeah, you wouldn't have got stopped out there. Anyway, I'm getting sidetracked by how well the 3-minute signal's working. Although we're not more signal-based, we're more levels-based. But this is the key I'm making. Point 3 is that retail trading trades almost blind to the levels where value and volume is. And so as a result, they have set stop losses and set take profits. And that's why we talk about 2-to-1, 3-to-1. And so the main signal, the buy signal, we still have a stop loss and we still have take profits, but those really are just for guidelines. They're not to be taken rigidly. So that is the big difference. So whenever you hear someone talking about, retail traders, they say you to be profitable, you need at least a 2-to-1 risk reward ratio. You need a 3-to-1 or 1.5-to-1. And so, I mean, that still is some, can be valid, but that is not how professionals trade. Professionals don't use risk reward ratios. They use targets. And that is the big difference. And so you can be profitable trading like this. Sometimes I never think anymore. I haven't for a long time thought of what's my risk reward ratio on this trade I'm taking. I simply put my stop loss in a safe place, and then I look to where the next target is. So for example, if I took this trade here, we can see we tested the upper BV once, we went up, and then we tested the H1 high plus 2, came back, made a double bottom. So remember, this is a 3-minute chart. So your entry would have been there. I mean, there was some risk with H1 high plus 2, but your stop loss, that would have been your entry candle, and your stop loss would have been below. I would have put my stop loss, big stop loss needed here, just over 50 pips. That would have been a safe stop loss. So you're not putting it, below the previous candle. You're putting it at a place where if price does reverse, then you're in a safe place from the previous low there. And then you set it a target. So maybe you set your target to this, to the previous month mid, or to this previous week VIL. So that is how it works. It's very different, So your stop loss is what is price rejected? What is price rejected? And so it's rejected this line, then your safe stop loss would be somewhere below the upper BV. And then your target is not 2-to-1, 3-to-1. I only set targets at levels. Now, this morning it didn't work out. I mean, I missed. My target this was the trade I took. I can't remember exactly where I got in now, but I took 50 pips. But this wick here, my target was the upper BV. And price just stopped a whisker below. Literally, I mean, it stopped, 3 pips below that target. And so at a 90 pip target, I took 50. I'd already, I was moving my stop loss up. So I was up 50, fortunately. So sometimes it doesn't always work out. And the reason why it stopped there, believe it or not, there was a pivot on the 1 minute that price respected. And so that doesn't always happen, but it happened then. So it doesn't always reach the target. I mean, they did pull back, eventually smash it. So, but there was like an 80 pip pullback. I wouldn't have sat through, I would have been up 89, then pull back almost to my entry point, wherever it was. Well, not quite. And then up. I wouldn't have done that trade. And so that is a real key, So retail traders always have their fixed, 2-to-1, 3-to-1 risk reward ratio, whereas professionals don't. They enter as close to the rejection, the test and rejection as possible. They put their stop loss in a safe place, maybe at the little swing low before. So if price does retest, you're okay. And then their targets are always at levels, never like randomly. Like you can see, look at these levels here. If you went for TP1, I mean, we are looking just at the 3-minute chart. There could be something on the 1. I mean, why would you set your take profit at TP1 in the middle of nowhere? There's nothing stopping price there. Right. TP2, okay, great trade. But look, there's no level there. No professional would set a take profit in the middle of nowhere in free space. Most professionals in this trade, they probably would have set their take profit around about, the H1 high, that +3, that would have been a good target. And I mean, you could also, have a trailing stop loss, but that could have also, reversed off that. So that would have been a good target. So that is a big difference. So, I mean, the market never moves randomly. there's always a reason. Even if this appears to be random, there may be something on the 1 minute chart. There's always a reason why price rejects a level and moves to the next level. And so it always moves between important levels. So if it rejects an important level, it's highly likely that it's going to travel to the next important level. So that is a big difference. So we don't just have like a random stop loss and random take profit. Our stop loss is around the level it's rejected. If we took this sell, went short over here, our stop loss would be there, and then our take profit would be the next logical target. So that kind of trade, there's still 100 pips in that. Remember, I've got the 3 minute chart really should look like that in terms of normal, 100 pip levels, but it's like that. So that's another key difference. So that may be news for you tonight, and it maybe take a while to get your head around that. I'm enjoying this trade. I mean, we got bright candles, and look, let's just see what's in the way in the 1 minute. So is there free space in the 1 minute? Look here, and this could go all the way to the previous day high. So don't press buy now. There's a lot of free space. It could pull back. I said often with the H1 high plus 3, these levels are often retested. So, and we can see, look what's here. We've got the H1 high plus 3. We also got a big round number, 47,800. So price may come back and retest this big round number, or retest H1 high plus 3, and then it may move up again, or there could be a bigger pullback right back to one of these levels the previous week, value area low. So price doesn't move randomly. If it rejects a level, it's always going to move to the next significant level. And that's why on our charts, we have almost as many significant levels that price respects as possible. So we'll just keep an eye. It's interesting, trading while we're looking, see if price does respect. So we've got the big round number at the same place. You can see 47,800. So that may retest for a while, go sideways. And if it breaks that level, then, price could move up. It could move to that previous day. What was it on the 1 minute chart? I mean, we are far away from the origin. That is the risk now. But the previous day high, those are massive levels that price loves to revisit. So right now there are sellers sitting up there, sell orders on the previous day high that were unfulfilled. So remember, price came up to the previous day high, and that's what made it. And after that, it went down lower. So that means there are sell orders up there. So let's just see what happens. If it rejects the big round number, I'll just carry on talking.
While you're there, Dad, you're there, a couple of questions, so we don't have too much to come back to. Man's asking a good one. That blue line just below your cursor, is that one of your anchors you've manually drawn?
Yep, that is the monthly. This is the March. Let me just see if I've updated this. This is the monthly mid-volume band.
Thought so. Great stuff. Yeah, that's why.
Yeah.
So manually drawing that. That is in the video that dropped today, exactly how to draw those anchors. So get into that. And then Jono's question will come to at the end because it's not directly related to this moment in time.
Cool.
So keep flowing.
So all tracking good? Okay, number 4. I'm just trying to see where where I can look at a chart and then obviously apply. I've already covered some of it. So basically, so number 4, what is the difference between retail traders and professional traders? So the big difference is often retail traders enter anywhere, while professionals only enter, at these key levels where there's value. And so I kind of covered that earlier. So we don't take, signals in the middle of nowhere. So here's an example. Although this was profitable, there were some pips here, big rejection. Don't know if you would have held your nerve there. This sell signal really is in the middle of nowhere. So that is a lot how retail traders trade. So look, these signals are not based on moving average crossovers. There's a lot more into it with these signals. But let's just pretend that there was a crossover here. You see, that's quite random. It's right in the middle of nowhere. So that's why retail traders could have been caught out. So this is a typical retail signal in one sense. It's the middle of nowhere, and often retail traders, sell signal, they're going to press sell, and there would have been some pips, but this thing could have bounced off, which it did, pull back, and it could have gone completely the other way, or basically stopped you up before it went down again. And so the big difference again is, so retail traders, they will often take signals in the middle of nowhere, Whereas professionals, they only enter at key levels. So I said this example here, this obviously is, we can see this test over here and a rejection and another test rejection. This obviously is a key level. There's a little bit of stack in there. We'll mention that later. That's a difference where how professionals trade. So they begin where price has tested and rejected a significant level. And so that's why, I mean, what they say with professional traders, they often enter where most retail traders would fear entering. And honestly, it took me a while to get used to it. I was really bound by signals. I would wait patiently for a signal. And so you look, here's an example. Like this one, you would have got some pips. You would have been lucky. But it takes a lot of courage to enter. So this would have been your entry candle. We got a double bottom. You can see we would have broken a trend line. I would have liked this line to just be below that candle, would have been preferable. But you got a double test. You can also see you've got a nice Heikin-Ashi reversal pattern. You got bearish, doji, bullish. So you'd have entered here before signal. So it takes a while. We tend to, now look at the difference from that entry there to where that candle closed. There was 55 pips. So can you see why retail trading actually carries high risk? Waiting for signals, that's telling you what has happened. Price is reversed and has moved up. And that's unfortunately the earliest we can plot a signal. And so professional traders, they enter way earlier, way earlier, often where people are afraid to enter. But once price is tested and rejected, that's our key rule. That is where the safe entry comes. And that's why a rejected level, a good level, is worth way more than 10 signals. So you could have a signal popping off in every candle here, 10 signals, but this is the key here, this candle here, rejection of a key level, and then you get a nice bullish candle. That's what I like about Heikin-Ashi. They do give you, when there's been a bit of range, dojis, and you get that pattern, they often become great places to enter. And so again, professionals always enter at key levels. Maybe we can see what else is the other key levels. Now, the lines may not plot all the way back, but if we just look back, a lot of the lines won't plot back, so we can't go too far back. But you can see it's everywhere. We can see here, look at this test. This was the H1 high. We can see price come up. Look at this, when it's breaking above, below, multiple tests. Look at those wicks on the level. Price breaks below, bounces off. Our mid VB, this is our weekly mid VB. Price comes up, retests. Look at this, the retest. And this is a good signal now because, well, we haven't got a lot of space, unfortunately. But when you get signals where price is broken a tested level, that's where you jump in, and that's where the good trades are. So number 5, we've got 8. We're tracking well for time. We'll have time for questions. I mean, the other big difference, this is more kind of just like exercising patience, and that's chasing trades versus waiting for trades. So very often, retail traders will chase after trades. They will chase the when can I enter? They'll look for like a bright candle. There's some momentum. I'm jumping in here. But that's super risky, The further you move away from what was tested and rejected, the riskier the trade becomes. Likewise, this signal here, look at this. Okay, there's momentum. We've got a bright candle. Momentum's picking up. But look how far we are away from a tested and rejected level. That is I would never touch a trade like that. Way too far away. And as I said, look, this signal came, how many pips? Well, let's just be gracious, 100 pips below the rejection. That is a way late entry, leaving pips on the table. And so often retail traders will kind of wait, and we all go through insecurity, but retail trading's like that. Has it really turned? Is it moving the other way? It's guesswork. You had no idea that if you're a retail trader, that the weekly upper volume band was sitting at this level. That's what's causing price to move up. I mean, even, 6 months ago, I wouldn't have known this. Although I was testing these for a while, I probably wouldn't have picked it up. And so again, so retail traders, they try to jump in once price is, moving, whereas professionals, they're looking for the rejection of key levels. They wait for price to come to them. And that's how I took my trade this morning. I mean, it wasn't 10 out of 10. There was a bit of risk in it. But if I just go back to this morning's trade, when I turn the charts on, where we're looking, I'll just have a look. Where are we? So we'll just go back. I mean, I was walking my dog when that came. Sometimes I have these expensive dog walks. Oh no, I waited for all the rejections of these lines. That's why it was slightly risky, because it was based on a rejection of the 233 and also breaking above the H1 high, and then it did pull back. It rejected it. But there was a level up here. It wasn't the two. Anyway, I can't figure out. But when I turned on the charts, I looked back and I saw price rejected a key level up here, oversold. And I was going to wait for it to come all the way back to down here. The previous day low was here, I think. Previous day low was way down here. Anyway, I waited for it to pull back, and then I was looking forward to go up again. So the point I wanted to make is that I wasn't going to jump in, because there was definitely, the bias was up still. So I was quite happy to let these pips unfold. I mean, there were reasons you could have taken some of these trades, but I waited all the way patiently. I saw price reject here. The bias was definitely up. And then I waited for price to come all the way down. Once it hit off, just kissed the mid VB, and there were other rejections, session open, tested and rejected. Then I was waiting somewhere over here to get in a trade. And obviously I missed the big one further on. But the point is, professionals don't just click buttons, like take signals in the middle. They wait for price patiently. So I waited all through this till it came down, and boom, I got in. Where was it? Somewhere around over here. And got 50, should have been 90, but 3 pips short of that target. So anyway, so professionals wait. That's why patience, I'll just delete this line, no longer relevant. And let's reset the chart view. And let's have a look at what price is doing on the 3-minute. So what did I predict here? That price would come back and retest the H1 high. +3, which has come down. I said often price pulls back, try to break below, and then we have this doji testing, and then price moving up again. So let's just have a look here. So we'd like to see in a better rejection, rejected our overbought band. So we're on risky territory once we start getting this high. So if it breaks this previous high, then we could come up to the 2584, also find its way up to our monthly mid VB. That is a magnet. So anyway, professionals wait for price to come to their levels to choose their entry. So again, when I'm trading and I see price meandering, I'm just waiting. Where's it going to come back to? So if price was here, I would say wait for price to come back to maybe a stack, which is great, some retest, and then your entry off those key levels. So that is the difference. So price, let's just see, it's going to get up. This is a real magnet, the previous day high. Remember, it came all the way down to the previous day low. So that's a massive, massive move. So price often moves again between these levels. All right, so that is point number 5. Number 6, I need to wrap up quite soon. Actually, I think I've covered point number 6, is just like a random stop loss. Often retail traders just have a random stop loss. There's strategies that I've tried before with other people where you were told just to have a 30 pip stop loss. You press buy, 30 pip stop loss is safe. And so often, retail trading, they just have a random stop. They don't have anything that's based on structure. So it'd be based on pips or X number of pips, while all professionals, they base their stop losses on structure. And so we don't just, I'm going to take 15 or 20. They're looking to where, price rejected and then to place a stop. So here, for example, a safe stop loss would be at that high over there. And so if you get it wrong, you get stopped out. Oh, price is going to pull back, stop you out. But you wouldn't just say, press sell and then take 30. So for example, if you entered here and you went back 30 pips, okay, that would have been safe, but maybe too high. So you don't just, retail traders will have a random stop. So for example, here's a stop loss. That's totally random. That's just luck. Now, again, I believe in my signals. There often is a bit of momentum, but that stop loss is in the middle of nowhere. In fact, that stop loss would have been too high. So, here, if price broke above and there were some other levels, you could have actually put your stop loss just below this previous level over here. That may have been even safer. And so professionals base all their stop losses on structure. Like this morning, my trade, I made sure that my stop loss was below the 233. Price had tested it. I knew if it came back, because of that, price couldn't break below before, that would have been a safe entry. Like this is random. Look at the stop loss here. There's a buy signal. There's a stop loss. You may have got some pips here. I mean, from this buy signal, I mean, I never would have taken that. There's 18 pips, but that's what you call a random stop loss. If you took this trade, you would have had to go on. Let's just have a look at the 3-minute. Your stop loss would have had to have been somewhere below the H1 high, below the big round number. You don't have to go all the way down. That would have been too big. But look, there's a rejection. That would be maybe a safe stop loss on that candle. So if price did pull back, that would have been maybe a safer stop loss. That is way too random. I mean, to enter a trade here, it's the middle of nowhere. That one, okay, maybe not too bad based on the H1 high. But excluding that, we never enter trades in the middle of nowhere. So professionals, so again, retail traders have random stop losses based on maybe 30 pips sounds safe, while professionals, they always base it on structure, and it would often be on the other side of the line that price rejected. Then number 7, almost done. I mean, this is very typical. I mean, I've made this mistake, is that retail traders are super trigger happy. They are trigger happy. And so they will chase every single move, while professional traders are far more selective in the trades they take. So retail traders, I think FOMO is a real thing. They fear missing out. They trade frequently. I mean, if you looked at my old chart, seriously, it looked like two kind of North American Indian tribes having a bow and arrow fight. There were just arrows up and down everywhere. There was just a mess. And so, it looked like there was a war breaking out between the Apaches and the Sioux or something like that. Or maybe that's not a good illustration. But if you, for example, went to a high time frame chart, you would have seen I was taking trades all the time. Sometimes I would take 10 trades in a morning, and it's still sometimes I had a good win rate, I made money like that. But I've changed the way I trade completely, Now I discipline myself. I only allow myself 2 trades a day. I don't revenge trade. So, I took 2 trades this morning. My first trade, I was stopped out for +4. And then I thought, okay, I've got one more trade. And the second trade was the 50 pip trade. So and that was it, And after I finished that I turned off. That was my trading, done for the day. And so, but retail traders, they will keep on pressing the buttons, the market doesn't reward activity, it rewards patience. And so traders, they try and predict the market. It's going up now, I'm going to press buy. We're professional traders, they wait for the market to reveal itself at key levels. They wait for the key pullbacks, like this testing this level. That's how the professionals trade. And so don't overtrade. I allow myself 2 trades a day. And remember, I want to say this, the pips you make on any given day are only yours when you turn your computer off. If you've made 50 pips and your computer's on, you risk giving back to the market. And so it's made me far more disciplined. I want to trade like a professional. And so I allow myself 2 trades a day. And knowing that I've only got 2 means that I'm really patient in waiting. And that's why I waited for ages for price to pull back to a key level. And again, I knew the market bias was up. And so again, I'm always looking for things like if you see now that there's still a good, let's just say, I think we've broken through a lot, but look at the previous week POC is way above where price is. Look at this, the previous month POC, those are the big magnets for price. So I always look in the morning, where are the previous week, previous month POC, even the previous day, that wasn't as high. But I'm looking to where price is more likely to head. Where are the weekly levels? Where are the monthly levels? Those are the magnets for price, especially the weekly POC, monthly POC. That gives me a good bias. Like I think I may have said it at the week's trading or the live event. Price the other day on the NAS had hit the overbought, and I was asked, when should I press sell? I said, hey, I said the market is moving up, the bands are moving up. All the POCs, the daily, weekly, and monthly are all above where price is now. The bias is up. And so I would have waited. In that case, I would have waited for price to move down, back to a key level, and then enter. And so I'm not going to wait for the first sell signal, for my trade of the day. I want to be patient and wait. That's what professionals are like. They're far more selective in their trading. And so they look for price to hit a key level and take a trade from there. And that's a good thing about trading with levels, is that, with retail trading, it could have been a point we only trade with trend. And so, that's the frustration, uptrend, and you miss a trade, and then you have to wait for hours. But you can do counter trends, So if the levels are positioned correctly, there's room to trade both ways. That's why if you're patient and you wait for the key levels, then you're going to get those good and big trades. Then the last one is just, it's probably, I've probably overcooked this point, but with retail trading, you're looking at indicator confluence. So you're looking at, I think I've covered this a bit. You're looking at, the MACD to agree with an EMA crossover, like the strategies we've used, our version 1 to 4. But what professionals look for is for levels confluence. And so with these kind of trades, for example, this nice rejection here, we weren't looking for the MACD to cross over. I mean, I haven't looked at the MACD for months. We weren't waiting for, 13 to cross 21. We were looking for for levels to come into confluence, those kinds of things. Those are the key things. And so confluence is when, we have multiple levels agreeing on both charts. That is the real key. So that is the key. When you have levels agreeing on both charts, they become high probability trades. And that's the key part of the whole strategy, is that we look for price to reject key levels that have been tested. Then you're not going to lose money like that. And so that's the thing with, especially when they are stacked together. Like this is okay. We just got 2 here. So what time was this? What was happening on the 1 minute chart here? We can see price didn't quite reach. If price had moved further into the oversold, overbought, that would have been amazing. Didn't quite, but close enough. I mean, there was a pivot there, plus a big round number. That would have been massive. That would have been great confluence. So maybe not enough confluence, but that's what professional traders do. They're looking for price to reject key levels, especially when they're stacked. All right, so when price rejects levels, you get momentum. When they stack, that is when you get the explosive moves. So especially when you have key levels around the volume band. So, at least, they say 2 to 3 times a week, you're going to get, 200 pip moves on the 3 minute. And they normally happen when you got like a PAC or VAL, VAH from the previous week or month sitting around a previous week, volume band, or even a previous month band. When you see those coming together, that's when the explosive trades come. So, I mean, in summary, retail trading indicators only tell us what is happening, prices moving up. But professional traders, when we trade with levels, we are told why it's happened, why price is moving either up or down. So I think I've covered everything. We're just looking at this trade here. We can see price is beginning to slow down, and doesn't look like it's moving higher for now. There's a pullback. So I'm just trying to see. Right. We are already very much, trades do become risky when you become overbought. We're right on the other side of the bands. So maybe that's not going to go high tonight. We'll wait and see. So, Ty, any other questions?
Yeah, we got a couple of questions. Just firstly to confirm, what was your total pip count this morning?
It was 54 to be exact.
So plus 1.
What do you say?
So 1 above 53. We've got a new number.
I see what you mean. Yeah, it was 50. Yeah. I'd moved my stop loss up to 50.
Jordan spotted it, and yeah. Anyway, I've been trying to keep it together ever since. But
oh my gosh,
those of you at the event, if you win at the event, you'll see the footage. 53 pips has pretty much become a new meme for Dad's trade of the day.
Yeah.
But let's get some questions. So I'm going to scroll back and find a few. So John asked one earlier about struggling to know when a trade, and this is an entire session probably, when a trade has turned around. Example, price has risen to the oversold band and we'd expect it to maybe bounce and we start to see a turn. Sometimes it's just a pullback rather than a rejection of a level. We're talking about entering when we reject the level, but even in some of the examples we've just looked at, it retests the level. So it's a bit long to probably decipher, but basically the idea of, okay, right now price is obviously above those bands on the left. Yep. And then he asked another question lower down, which kind of links to it to some degree, because he was talking about if the weekly or monthly POC levels are outside the outer bands, this is more risky even if the trend is strong in that direction, understanding that we still need to reject levels. So it's kind of like that thing we've got right now of, you can see on the left-hand side, we've got the red, oversold bands on the left, but we're still underneath the oversold bands on the right on the weekly.
Overbought.
So we've still got some higher time frame magnets. Would that be a way to phrase it? But obviously risky to be entering above the bands But when you can see, I mean, what would give you, I guess that would be the question. What would give you enough confluence to potentially take a trade on when you're in oversold territory on a 1 minute, or would you rather just err on the side of safety?
Yeah, look, to be honest, I don't take many trades that break. Like, for example, this is overbought. That is risky. The only times that make it, safe is if then you really got to make sure that multiple key levels have been rejected. So in this case, there's quite a lot going on. Look at this. It may not be clear on the video, but we've got a big round number. We've got two pivots stacked together, and look at price doing a lot of testing around that level. And just below that, we can see we've got, although we didn't test it enough. So I would love to have seen price also, testing these levels on the 3 minute. But I mean, to take a trade like this, you really want to have rejected levels on both charts to make it really safe. So these are risky, once you get into overbought territory. And plus, although we got some POCs still way up here, they're magnets, we can see, I mean, even on the weekly chart, we're getting close to overbought. And so trades above the upper volume band, on the weekly, yes, there's still pips there, but, we're getting close to overbought on the weekly. So, I mean, the only time it's safe is if the bands are still sloping up. I mean, if they were horizontal, no ways. If this overbought band was horizontal, that would be more risky. But we can see here, these bands are sloping up, the mid VB, upper VB. I mean, this means buyers are firmly in control. So that would be something I would look at, the angle of the bands. So, I mean, we're looking now at the trend of the bands, TrendForce is the force, the volume, buyers are in control, we're above the mid VB, but look, these bands are also pointing strongly up. So still showing bias here, up bias. We can see, I said this was the next target, previous their high. How many pips to go there? That's a big magnet, 15. Don't get pressed buy now, that's very late entry. But we can see prices hit the 2584. Again, we got the mid VB here from the monthly, also a magnet. I'm kind of answering at the same time. So if there are magnets above, it makes it safer. But look at the angle, we can see this upper VB, that's definitely sloping upwards. Definitely, look, the weekly is sloping upwards. So that's still a good point, a good sign saying that buyers are still in control of the market, although we are close to overbought. So I don't know if that answered the question.
Yeah, that's good. And this might also, Daniel's question will link into it, depending on how many examples we're able to squash in now based on the time. But asking for some examples of what rejection of a level looks like. And maybe just stress the doji pattern looks like as well, because some people may have never seen that, and we don't even have anything on this channel with that now that we've started a new one. But that, bearish doji, bullish, even to the left.
Okay, here's one. Here's an example. Candle.
But yeah, there we go.
Looked at this one here. Look, here's a good example. So we can see price came down and it hit the upper VB. It rejected. That came up to, this is the H plus, what is this? H plus 2, H1R plus 2. Rejected that level, came down to retest. So that's what it's obviously we love more than one level. That's only one level. But that's what a retest looks like. It tests, rejects, comebacks, retests, and then moves up. So, and there you can see the pattern here. This is nice. You got the bearish, doji, bullish. So that's a retest. Now we'd like to see, more levels. So we didn't, I mean, look, this is a monthly. What's that previous week mid? I mean, you millimeters below, that's almost, it wouldn't be, you could say that is really testing the mid level there. You can see, so there's a test reject, there's a test reject. It tests a high level rejection. That's multiple tests of those levels. So that's what testing and rejecting looks like. Let's just see.
And even if, looking left of that, you can see how aggressively price rejected that level just earlier on in the session. I mean, look at that wick, those wicks to the left.
Where we're looking? Yeah, massive.
So that's also things to look out for, guys, is how did price behave the last time we were at this level? Did we accept it and break above it, or did we just flat out reject it? It's a high chance that you're going to see the same battle fought and potentially lost when you have that much of an aggressive wick at a level.
And likewise, if if it rejects a level, either it's going to reverse down, or if it accepts it, if it breaks through, then you got a continuation that can also bolt up, because you can see when there's a lot of activity testing these levels, if it closes on the other side, often that kind of bolts up. So it works both ways.
Yeah, good stuff. Think that might almost cover it. I may have missed one, but I think we're good. Martin was saying things about, I don't know if he was responding to a question and asking one at the same time, but often, I'm just going to read it. I think often on a reversal, on a rejection level in the table, the M5 and M8 are really low in strength. Does it mean you don't use that to enter a trade, but more to decide how long to stay in a trade? So I guess there's a question about rejecting, but then also taking into account the strength of that move on those other time frames, possibly.
Yeah, I mean, basically, this table was never meant. Remember, we were 50-50 about having this table. The point of this table is just to help you stay in a trade longer. So obviously, if it's very strong, if you say, for example, you had bright green triangles, then there's a sign that continuation is likely to continue towards target. So if they're gray, and then look, that was my prediction for the next target. Are we going to? Looks like we could even go higher. Anyway, yeah, so basically this table is not for entry at all. It's simply to help you stay in a trade longer. So it could just serve as confluence. There's a signal and the time frames are all up and they're strong. Then that's a sign, stay in the trade. So it's not really, I never use this table to enter trades. I mean, obviously, if, for example, right now, the M8 was a bright triangle down, that could be a bit of a warning sign. So, but it's mainly to stay in trades longer. And
cool
look,
stuff.
I predicted that. Look, this is what trading's like. I said that's going to be the next target. When you're way down here, when we reject, I said if we reject H1 high, the next target is the previous day high. So how many pips was that from there? So that was 75 pips. Now that was predictable. Price moves between predictable levels all the time. I said if you retest, we're going to reject and go up to that next level. I mean, it's not rocket science. Eventually, you'll learn to look at a chart and know exactly what price is going to do, up to a certain level.
Very cool. Very, very cool. Thanks, Dad. Well, everyone, I think that's us for tonight.
I'll stop share so they can see your beautiful face.
Stop it. Yeah. But guys, thank you, Dad. That was, let me just check. Are we getting a PDF of potential targets? Robin, maybe just rephrase that question. I'm struggling with the typo in there. But there is those two videos from today on setting up key levels on left and right hand side, and the other video on how to drop those anchors on left and right, and a few other key points in there too, depending on what session you're trading and if you're wanting to lag those monthly levels, like if you're in the first week of a month, etc. So there's a lot of detail in that video, but it is loaded. So over 300 cuts made in that 13-odd minute video. So lots of detail. There is a light in the tunnel. Yeah, at least that's it. Guys, give yourself some time. Like this is the biggest shift you would probably ever make on your trading journey. Like tonight was all about going from that retail mindset to that institutional mindset. And so a lot of what we've all learned and had ingrained in us through trading purely with signals on trend is no longer your subconscious norm that you need to trust. It's learning to identify those levels. And the more you can just go back and build trust and faith in how price moves between these levels, the better. So, part of your homework is just getting familiar with it and give yourself some time there. It's just going to take a while to learn everything, remember everything, start recognizing the lines, the levels, the colors. And it's a lot at first. And if you need to turn some things off to just focus and learn something, I think like you probably know exactly what the 233 looks like. If you were on version 4, the 233, the 55, the 2584, the moving averages, the 987, all the numbers. You could turn off the moving averages to give yourself some mental extra bandwidth to just start learning what all those volume bands look like and what the key levels look like, because you already know what those moving averages look like if you've been around with us for a while. So that's 90% of you. So in that sense, do whatever you need to do to start at a subconscious level, learning and memorizing these levels, these colors, and just getting used to how price moves between them. And that'll build your faith in how price moves. So very, very cool, Dad. I appreciate that. That is the big shift, moving from just being signals based to really structure based around the volume.
That's the biggest difference.
That's the biggest difference. Mindset is the key. Yeah, there we go. And I love it. Vic is saying pro is powerful. Yeah, for real. There's nothing else that we've ever seen like it. And that's why we're here, guys. So give yourself time. 1 week in, like think about if you were starting your trading journey 1 week ago, where you'd expect yourself to be in 1 week. Like a lot of us have got some years under our belts, but learning something brand new, give yourself some time. That's all I'm going to say. Give yourself some time, and we'll do our best to stick on top of answering questions as much as we can, while at the same time having some measure of healthy boundaries and whatnot. So I can tell you guys now, you're not probably never going to get a reply from myself on a Saturday. That's one of the days I'm off my phone entirely. And on Sundays, especially in the first half of the day, Dad and I are all systems go at church. So weekends, little less, but during the week, inside of some decent hours, obviously we're in different time zones, we'll do our best to respond as much as we can. Otherwise, in the meantime, guys, go through those videos, especially the ones from today, rewatch them, do whatever you need to do, and we will see you for live analysis on Thursday morning, 5:30 a.m.
Or new people may not know how to download an update. Do you want to just cover that quickly?
Oh, it's just reloading the indicator, basically. So there was an update Dad covered in the beginning of the session, a very simple one. Most of you, if you're not trading Forex pairs, you probably don't even need it unless Dad, you snuck in anything extra in that update. No. But you basically just remove it from your chart and re-add it from the indicators tab, and you'll have the latest version. Sometimes you get a little purple circle next to the indicator to tell you there's an update. I didn't see that. I don't know if that's happened to anyone. If it does, you just click the refresh button on it and it updates. Otherwise, remove it from the chart, re-add it from the indicator invite only section, and you're good to go. So that's us. 9:10. That was a long one. We'll cut it there. All right, guys. Enjoy the week. Trade safe, and we'll see you in the chat. Good night.